These are the 7 signs you should watch out for when you're looking for a housing market crash. My name is Orlando Hubbard. I'm a real estate analyst. We're going to look at what you should watch out for to tell when a housing market crash is upon us. The first thing, rising mortgage rates. Now, we do know what's been happening with the mortgage rates, and how they have gone up, skyrocketed from, we were at a 2 to 4%, 2 to 3, lowest, we got as low as 2% now, ever since like COVID and the pretty much implosion that happened after 2021. We've seen a huge surge in mortgage rates. Now, they have lowered. I definitely have lowered. So last week's rate, I have this article here pulled up here. They have been talking about lowering them, and they have been coming down. If we look at last week's 30-year fix, it was at 6.94%, which is pretty much hovering around that 7% mark, and it dropped 6.7%. Now, a lot of people get excited about this because they think that dramatic drops are going to happen. Here's the thing about it. We're not going to go back to those days of 2 to 3%. We may get as low as 4 to 5%, but I believe that it's my opinion that we're going to be pretty much in this area, hovering around this area. And the way that we saw the mortgage rates skyrocket after that 2021 period was the first sign, one of the first signs that you can definitely look out for when you're paying attention and trying to see. Look at the 30-year fixed jumbo, which is pretty much like a riskier loan, 7.1%. Now it dropped back down to 6.87%. That's pretty high for that type of loan, honestly. It's a riskier loan. It doesn't have as many criteria to meet. And, having them up this high is super risky investment. And you're going to see a lot of people not want to take these loans. We'll look at a little bit here going forward. Now, the next thing that I want to talk about is the home price declines across multiple markets. So you'll see a lot of home prices start to decline across multiple markets. You really saw it, and I have a couple articles that I like pulled up here that pretty much tells the story. You know what I mean? Florida is one of the housing markets that's really cooling down. I see it a lot here in Austin. I'm in Austin, so I'm local. But let's take a look at what this says. So in Green Acres, Florida, an enclave 10 miles southwest of West Palm Beach, the median listed price was $259,000, 13% less than in January 2024. Housing prices are drastically decreasing because sellers are starting to realize that we're not going back to 2 to 3% interest rates, and B, that nobody's going to purchase their overinflated home. So this is going to cause a huge correction, a huge swing in the pricing of homes. I say crash, but I always like to say more so correction, things going back to the way that they actually should be. So when you see sellers start to drop their prices, understand that is a signal for home prices housing market is actually going into a period of correction. So that's another sign to look out for. The third sign that you want to look out for is rising foreclosure rates. Let's look at this. Now, here's a video I did a few days back about zombie foreclosures. This was like super, super interesting to me. They're happening in a lot of the 5 states. Here's 5 of the states that zombie foreclosures, which is basically people getting foreclosure notices, and they actually leave before. They take it as one way of like saying that they're actually being foreclosed on, and they just leave the house or they just go delinquent completely. It's happening a lot in Missouri, Michigan, South Carolina, Indiana, and Kansas. This is an indicator that because of the cost of living, the cost of inflation, and things like this, homes are becoming less affordable for homeowners. And now when you see these foreclosures, and I also have a list of look at these foreclosures here. This is just in my zip code 78724. All of these foreclosures that we look at that you can find here in Austin. So when you see these types of things happening, foreclosures piling up, 747 vacant properties in West Palm Beach in the first quarter alone. Newark is the same. Newark is seeing this something similar. Chicago, 472 vacant properties in the first quarter. So foreclosures continually going on the rise, meaning people are priced out. People cannot afford their homes anymore. That's a sign that you want to watch out for. Now, the fourth thing is declining home sales volume. When you start to see homes actually sell less, which we have been seeing as well. We've been seeing, and we'll cover this one as well, record numbers of homes piling up. So, a lot of the homes in the area, and this is Florida. A lot of the homes in the Florida area are not selling they're not selling as fast. So you're seeing less home sales, which means that buyers are not interested as much in the homes of these sellers, especially with sellers that are still pricing their houses extremely high. So you see that, and then that's an indicator that something could be brewing in terms of a crash. The sixth thing is the rising employment rate and economic slowdown. So we know right now there's a lot of things happening with the government and the tax cut. The job cuts that are happening inside of the government. This could be a huge shift in the market because people need jobs in order to pay their bills, to pay their mortgages and things like that. If we're seeing these huge layoffs and those sorts of things happening in the market, you're gonna see less people are able to afford, and that therein may turn into more foreclosures, more people not actually purchasing houses that go on sale that maybe were going to purchase house, but they just lost their job. And the last thing is the bank tightening lending standard, the banks when they tighten their lending standards. So, excuse me. I have this article from the Feds here. Now, it does say that on real estate lending, their standards have been pretty much unchanged for most loans, except for subprime and non-qualified mortgage and jumbo mortgages, which is the more riskier mortgage rate, mortgages or lending loans, for which modest net shares of banks reported having tightened their standards. Similarly, banks reported that standards for HELOCs remain basically unchanged. Banks report weaker demand on balance for most loan categories over the fourth quarter. So around last year, a lot of banks were reporting that the demand for different types of real estate loans were lower. And that lets us know that buyers are not as interested in the market as they are right now, or taking on debt right now, which is a huge part of real estate. A lot of people don't understand that debt is a huge part of how people purchase real estate, how they operate in real estate, and how they create the leverage that they need to buy multiple properties. So when you see those sorts of things drop, you have markets that potentially have houses that are sitting on the market for an extended amount of time, and the market as a whole slowing down. So that's all I have. Those are 7 signs that you want to watch out for when you're looking for, is the market crashing? Let me know in the comments what you think about that. And if you like this video, definitely check out our last video. I think you love that one as well. Peace.